Thank you so much for that, Mitali, and opportune time to take this discussion more towards the fundamental side and more maybe top down. We have with us Deepak Shenoy, CEO at Capital Mind Mutual Fund, to talk to us about exactly that. Good afternoon, Deepak. Let me first start off by trying to get a sense from you. We've closed Q2 in terms of earnings. Uh, Talk to us about where are you in terms of what basket do you believe or you're most optimistic about at the end of these Q2 earnings? What's looking the best given the commentary and given where we are at, where valuations are concerned?
So I think two aspects here. The results were kind of decent compared to what we thought would be very muted because most of the impact of the tariffs and all that stuff would have hit us at least in this quarter. And the GST cuts did not really meaningfully impact the quarter's results. So I think in that context, Nifty's earnings growth of mild, early double digit or big, large single digit. Small cap and mid cap profits have grown more than 10, 11%, which in a phase where inflation is very low means substantial real growth. If you I mean, a 14% earnings growth is different at a 9% inflation or a 7% inflation versus at a 2% inflation rate. So you're actually getting a fairly good earnings bump now, despite low inflation. And also, what's happening is that there's early signs of capex revival at the corporate sector. There is some signs of a retail slowdown, which I think will change with the GST cuts. Perhaps the October sentiment was quite good, at least from what we saw in auto and what we saw in some of the financial services, smaller players in the smaller financial services pack. I think we're seeing a fairly good move over there. A lot of the underpriced, relatively cheaper, smaller banks have started to react positively. Mostly those that are following a digital-led strategy going forward. And I think there's a lot of movement on that front. The second area that's actually quite of so auto is one, of course. Auto, I think, is a direct beneficiary, but we're seeing some important movements in healthcare as well, where there's some kind of consolidation and growth seems to be more evident in that, even on the results. And of course, engineering, I think engineering is a more longer story. So we're talking of manufacturing in the high-end engineering space. I think that should do fairly well, and some of the capex companies as well. So I would say these are the areas I think will do well in the next few years. But the bigger thing will be to see whether the trajectory is continued in the October to December quarter. So far, the numbers look quite good. Inflation looks low. We are poised, hopefully, for a rate cut at some point because inflation is so much lower than the current interest rate that it's not feasible. India is a capital deficient country, and we can't keep starving ourselves of capital by keeping interest rates this high when inflation is so low. So I think, hopefully with a rate cut, we'll get some stimulus as well. And if there's even some sort of a US trade deal, I don't think the tariffs are going to go off. I think we just have to learn to live with them and export less goods to the US and focus more on building for India.
Interesting. But Deepak, do you believe while these structural stories may remain in the very interim, this is becoming more like a trader's market? I know Kunal would be very happy here. And within sectors as well, it's the bottom-up plays which are sort of finding favor.
Yeah, it is actually, Aisha. You're seeing the a number of results. In fact, in some companies where the valuations have been high, even good results have meant a stock is broken down. In other companies where the results are ordinary and the stock has already been beaten up, you're seeing stocks moving up. So I think there's a bit of a mean reversion play of some sort. But the trending plays have just started. I think we're just seeing some strong trends emerge. Like I was saying, even in prices, we're seeing these healthcare names, some of the smaller banks, auto, all of them showing very strong sustained trends for the last 2 months. We've not seen sustained trends for a year. Anything that beyond a month and a half tends to break down. So I'm hoping that this kind of continues, and therefore we get from a trader's market to an owner's market as well. But I think all markets are traders' markets. Some markets are, everyone's markets where everybody seems to make money. We haven't gotten there yet. I think the transition to there is in the process of happening. And I think hopefully we will get a strong up move once the economic recovery kind of starts to show more meaningfully in, across the sectors that we're talking about.
Welcome back. You're watching Closing Trades here on ET Now, and we're live from the SBI Live Studio and in conversation with Kunal Bothra and Deepak Shenoy. Now, let me come to you, Kunal. One of the larger banks have decided to go in and consider a stock split, which is Kotak Mahindra Bank. That stock split expected to be announced on the 21st of November. We'll have to see how that plays out. But the stock is up 1% or so in trade. There's been plenty of movement on the stock price, as you can see, viewers. Kunal, what next for this one? Because we've seen a bit of a cool off from the highs. It's refusing to breach certain levels. Give us a sense of where's the support, where's the resistance, what should one expect on a Kotak?
Yeah, so 2050 broadly is a good short-term support for the stock.
Yeah.
Even in this last 4 weeks of a sell-off prior, the stock had not broken below this level. And if we go maybe some time back, then I think this was acting as a major gap resistance for Kotak Bank in the previous leg when the stock had seen a sharp sell-off. I think that was in the month of March, April, May somewhere, where the stock had seen a sharp sell-off and a close below the 2050 odd mark. So that remains to be a crucial support for the stock. Even on the shorter term charts, as we look at the stock price, it's nearing a trendline support again at closer to 2050, 21. It could be a hurdle point. So in this kind of a setup and a scenario, we ideally look out for short term trades. 2050 could be kept as a stop loss for investors looking at a buy, but then 2200, 2250 would broadly remain as a major target for the stock.
Okay, that's that on Kotak Mahindra Bank. And Deepak, where is it that you stand on the entire BFSI space and especially banks? Because that's where you see the maximum churn happen. Suddenly it was PSBs for a fortnight, and then you have the private banks once again taking center stage.
Yes, I think the early stages of this, Aisha, is that there is a lot of hopes on credit growth resurfacing. We're seeing some early signs of it, but it's still at 10 odd percent, and it's not meaningfully more gone about 12. For an economy to grow, eventually the overall credit growth has to be at the same levels as we expect the economy to grow at a nominal basis. Nominal, we've moved at about 9.9, less than 9%. So credit growth has been kind of relatively slow. So we're seeing the early signs of some kind of a revival, but it's not yet meaningful. And it will, when it starts to grow really strongly, the big private banks will start making a significant dent. But I think we have seen a valuation change in public sector banks. They were valued at substantially lower. Now with the integration of a lot of banks coming together, a lot of digitalization in that sense of a lot of their activities. Some of the public sector banks have benefited and gotten a better price to book than they earlier used to get. Also, the mergers have kind of played their time out, so they've been able to iron out the NPAs meaningfully. With the small private sector banks, some of the players have actually taken to digital much better. We've seen some interest now from foreign banks in acquiring large stakes in certain Indian banks. So I think that has also played a role in giving them a higher price to book ratio than earlier expected. The NBFCs, I think the larger NBFCs will probably still do better. The smaller ones are still struggling for a decent asset liability mix and the net margins, because we're seeing anything below AAA or AA plus, the financing rates become substantially higher. The spreads have increased or widened as your credit quality worsens. And so therefore, I think some of the smaller NBFCs will struggle in this environment, especially when interest rates are falling, to be able to A, raise capital at lower levels, and B, to be able to lend at the rates that they want to make their spreads. So they're trying to lend at 13 to 18%. When in a falling rate environment and aggressive public sector bank positioning, you're going to get a little beaten down in that respect. So I think some of the larger NBFCs will do well. The smaller ones will struggle through this environment until they get their asset liability mix better. So the bets would still be small private sector banks, larger private sector banks later, and then large NBFCs.
Deepak, if I can come to you with regard to the Bank Nifty. Now, we've clocked record highs on the Bank Nifty. So just trying to contextualize this a bit, give us a sense, where do valuations stack up versus earnings growth? Because H2 should likely be stronger, aided by better margins. Can this kind of rally in the banking index sustain, is what I'm trying to get.
So valuations right now, to be honest, have become better only because all these big banks have sold yes bank stakes and recorded fairly large profits on their net profit basis. So therefore, their core operations haven't done that well. Didn't expect to also because of all the turmoil in exports, tariffs, changes in there was an up move in the yields of government securities. So they saw that hit to their treasury income as well. So there is, some of that will recover. The treasury income will probably do better in the last half. They will probably see some kind of lending growth as well. But they won't have all these one-timers for like Yes Bank stake sale and all that. So I expect some of the larger private sector banks to still take some time. So the banking index earnings are not going to grow at a meaningfully higher rate. So their evaluations will remain a little bit more expensive than public sector or small private sector banks, where I see both earnings growth as a big possibility. And second one is on they don't have those treasury gains like Yes Bank shares and all as much as to impact their income. And they're also more aggressive on the lending front. So there, I would say the index wise, since it's based on more heavyweights, and we're going to see a change in the structure, right? From next month or something, there's going to be less of the largest two banks and more of the others. So hopefully that broader structure will give it more of the earnings flow from some of the smaller banks to show in. But I mean, I still think that will take some time because the way the index calculates earnings is on absolute basis. It's not weighted based on the market cap. So therefore, the earnings valuation from the index perspective will be high. But I still expect the smaller private sector banks to do better in terms of earnings growth and perhaps therefore in terms of price as well.
Thanks so much, Deepak, for coming in and speaking with us. It's been a pleasure speaking. Grow's market cap is the other piece which has made news. Let's quickly pull up that stock price. Stock is flying in trade, by the way. I think it's the fourth session post listing, and we've notched 1 lakh crore in terms of market cap on Grow. The stock is up nearly 70% from its IPO price. We'll talk about this and more. Stay with us here on ET Now. We'll step into a short break. On the other side, we'll talk about that and more.